Coinbase exec slapped with insider trading lawsuit as banks get spooked. Crypto exchange Coinbase's top executives, including Chief Executive Brian Armstrong and board member Marc Andreessen, participated in insider trading to avoid $1 billion in losses in the days after going public 2 years ago, Coinbase investors claimed in a lawsuit made public on Monday. The board quickly sold $3 billion in stock before the firm's management announced negative news that sent its price tumbling, the lawsuit claimed. Armstrong sold over $290 million of Coinbase stock in a direct listing. Andreessen's venture capital firm Andreessen Horowitz shed nearly $120 million, it said. One long-term investor involved in the legal battle claimed that, quote, within 5 weeks those shares declined in value by over $1 billion, and Coinbase's market capitalization plummeted by more than $37 billion, end quote. Indeed, Coinbase executives have a long-standing tradition of dumping huge amounts of stock. At the end of March, Protos reported that execs have sold 9 times more stock than they've bought in 2023 so far. As of March 23rd, since late December, company insiders sold over 500,000 shares worth over $26 million. Only 57,000 shares worth almost $2.6 million have been bought. Armstrong is by far the largest dumper among Coinbase executives, selling almost 300,000 shares worth nearly $18 million. However, Coinbase has denied the claims made by investors in this latest lawsuit. Quote, as the most popular and only publicly traded crypto exchange in the US, we are at times the target of frivolous litigation, end quote, a Coinbase spokesperson wrote Bloomberg. Quote, this is an example of one of those meritless claims, end quote. Coinbase insider trading sounds familiar. This isn't the only legal headache Coinbase is currently facing, by a long shot. Nor would it be the first time insider trading occurred at the firm. Ex-employee Ishan Wahai recently pled guilty to 2 counts of wire fraud for tipping off his brother and friend about a cryptocurrency that would soon be listed on the exchange, resulting in the trio making a tidy profit. What's more, Coinbase received a Wells notice from the Securities and Exchange Commission in March, warning that the firm was likely selling unregistered securities and therefore violating federal law. Coinbase responded, quote, we do not relish litigation against the Securities and Exchange Commission, but we will vigorously defend ourselves, end quote. The firm sued the commission the following month over an administrative matter. As US regulatory concerns mount for Coinbase, it has sparked initiatives to focus abroad on jurisdictions friendlier to the crypto industry. On Tuesday, Coinbase announced an offshore crypto derivatives exchange in Bermuda. Meanwhile, US banks are getting spooked by the scrutiny. Wall Street Bank Citi cut the rating of Coinbase stock from buy to neutral on Monday and slashed its price target from $80 to $65. Analysts wrote, quote, Coinbase's notions of redomiciling outside of the US, the company's public responses, and now a formal suit against the commission are indicative that the Wells notices process has not yet been productive, end quote. They added, quote, the failure of Signature Bank and whether it was crypto-related along with other events of the past year are all fodder for the commission, end quote. Got a tip? Send us an email or Proton Mail. For more informed news, follow us on Twitter, Instagram, Blue Sky and Google News, or subscribe to our YouTube channel.